I just look at what the market is focused on, and it seems to be on the property, the size of your provisions for the Chinese real estate exposure. How big a problem is this, Ewen? And do you expect it to materially rise in a rising rate environment? Good morning.
Good morning, and thanks for having me on the show. Look, I mean, overall, I think we're very pleased with this set of results. Profits up materially, capital returns up materially. Our exposure to China real estate is just over 20 billion. About half of that sits in the offshore book. We have taken some incremental provisions today. I think this follows sort of policy tightening that happened at the back end of last year, which has caused some liquidity issues for the sector. But I would keep it in perspective. You know, the $10 billion is about 1% of our overall property exposure. So we're sort of managing through and do expect recent policy measures to ease some of the liquidity pressures we've been seeing in that sector.
Okay, so you see policy response as being the ballast. Look, a lot of people are saying that when zero COVID ends and when the opportunity is for people to leave Hong Kong, that this property market could face some pretty big headwinds. Do you agree with that?
No, I mean, I think Hong Kong has shown itself to be remarkably resilient. So it's obviously going through a bit of a COVID wave at the moment. But as we know with Omicron, it passes through most economies in about a 3-month period. We're not having any issues attracting staff into our business. And we're seeing continued tight supply in the Hong Kong property market. Our provision coverage is very good. So, you know, we are and remain long-term bulls on the Hong Kong market.
To the buyback. Normally we start there, but I had to sort of flick it around because the market is looking at the China story. Ewen, when we caught up at the end of Q3, it was $2 billion. You talked about a progressive dividend. Today it's $1 billion. I know it's a tailwind to the $2 billion we've just had. The estimates that I had from a number of people were for a lot more than $1 billion. Why $1 billion? Why much less than the end of Q3?
So we're still in the middle of our $2 billion buyback program. We think the dividend per share is up 2/3 on what it was last year. So we are trying to do a mix of both dividends and buybacks. I think overall, we think we are in line with consensus expectations on the buyback. I don't think many people were expecting us to top it up at this point. We are seeking to manage our capital base down, and this should be seen as one measure as part of that.
On the debt market side, if I look at the fourth quarter for Wall Street, look, it wasn't great for them either. But looking at your fourth quarter on the global debt market revenues, 99% of that drop in revenue, it's $1 million. It looks a little bit extreme. Is there something that went wrong? Is there a one-off? Is it just the flow wasn't there, Manus? Just explain to the market what that was.
Okay, overall, I think we were very comfortable with the performance of our global banking and markets business in the fourth quarter. You're right, the debt market business had a tough quarter. Overall, though, some of the other revenue line items like FX, capital markets advisory, security services all had good quarters. So overall, we thought it was a decent quarter out of our business.
We're trying to understand how many rate hikes are going to come down the pike from the Fed. JP Morgan say there's a possibility of 9 25 bips at a time. Do you see that kind of risk, Ewen? Do you see a position where we could get up to 9 rate hikes of 25 basis points at a time?
Yeah, look, I mean, I would say we don't see it as a risk to our business. Actually, the reverse. We are very, very rate sensitive as a stock. Actually, more rate sensitive than most bank stocks. You'll have seen in today's results that we've actually, on the back of that, brought forward our return on tangible equity ambition of getting to 10% plus returns by a year. So sitting when we were having this chat 3 months ago, Manus, I think we thought that was not going to happen to 2024 on the back of a very, very big shift in rates. We're now predicting that a year early.
So you're putting that forward by a year early. What do you think we'll get from the Fed, Ewen?
Look, we certainly agree with the consensus view that we're going to see a considerable number of rate rises happening over 2022 and into 23, both in the US and also in the UK here.
What can we get in the UK? 4 people voted for 50 basis points at the last meeting. Do you think we'll get 50 basis points in March? And where do you see rates by the end of the year in the UK?
Yeah, I mean, I think we see rates going up materially from where they are today, whether we see 25 or 50 basis points at the next meeting. I think we're on a progressive set of rate rises, and the currency that we have most interest rate sensitivity to is sterling. So again, I think it is very, very positive for our UK business, on top of, continued good performance out of the business.
What about the mortgage market there, Ewen? Because obviously you've got this new ECL in Hong Kong and in the UK. I also noticed that there is, in part for the UK. In that rising rate environment in the UK, are you still going to be active, pushing ahead, trying to get market share in the mortgage book there?
Yeah, look, we are structurally underweight mortgages in the UK. We have grown that book by about 50% over the last 5 years. We had another good quarter, flow market share of over 9%. Our stock market share is only 7.5%. That's about half of our share of current accounts in the UK. The competition in the market has toughened up. Front book pricing was below back book pricing for the first quarter in a while, but we are continuing to generate decent returns on new business, and I think you should expect us to continue to be competitive in the market.
So from that, are you comfortable with that sort of like underexposure, or will you be pushing to gain a little bit more in a rising rate environment?
Yeah, look, I mean, I think, the rising rate environment needs to be seen in context. Until recently, we were operating at 300-year lows on interest rates. If interest rates go up a couple of percent from here, I think affordability still remains robust for most people. So yes, you should expect us to continue to seek to build that book and take share.
Ewen, we're waking up this morning to an escalation of risk between Russia, Ukraine, an emergency meeting at the United Nations. What exposure does HSBC have directly to Russia, to corporates, or to the oil and gas sector in Russia? Your exposure this morning, sir.
Yeah, look, we have a very small business in Russia, mainly focused on commercial banking and wholesale banking. Our overall exposure is very, very modest. Yeah, our main focus today will be on the safety and security of our staff over there. We have just over 200 staff. So, and financially, I think very, very modest exposure.
In terms of crises, and you have lived and worked through many moments of angst in banking, the risk is financial sanctions, Ewen. What are the unintended consequences? You and Noel have got to sit back with the board and assess the risk of sanctions on the world, on flow, on money. How do you see that risk to the financial system if those sanctions come to bear from the United States and from Europe to Russia?
Okay, overall, I think, we have been looking at the second and third order consequences of what may happen if Russia were to invade Ukraine. I think overall, you will see an impact on the energy markets. I think the sanctions policy and how that impacts us will be very, very modest. So overall, I think you will see a short-term dislocation in the market. But overall, I think this is not going to be a sort of major geopolitical event that's really going to dislocate the markets at this point.
What worries you the most at the moment for 2022?
Well, I think overall, as has been the case for the last couple of years, it's been the impact of potential new variants coming out of COVID. When we spoke a few months ago, obviously Omicron didn't exist. That's now rolling through. But yeah, the principal risk is, I think, that we get some new variant that has a higher death rate than what we've seen with Omicron. So I think that is the biggest delta that we're going to see in 2022.
Well, if we go back to a year ago when we caught up, it was the headline. It was moving almost 90%, and of course you can correct me if I'm wrong, of the owners of revenue within the business to Hong Kong. We now have a city with social constraints, zero COVID. It must be very tough to live there, certainly from the people that I speak to. Can Hong Kong still realistically be a place that you will actively want to move people, or that people will want to stay, Ewen?
Yeah, look, we are hiring people into Hong Kong. I know in my own team, I've just recently made 2 of the 3 senior hires that I've just recently made have been people who are going to relocate into Hong Kong as part of their jobs. So, yeah, we are different. Hong Kong is a third of our overall profits in the quarter. We are long-term committed to the market, unlike others. And we're not having any problem recruiting people into Hong Kong. I think at the moment it really is, up to the government of Hong Kong to decide how they want to manage COVID. I mean, I come from New Zealand, so I'm used to having very, very tight restrictions in my own country. But
do you think they've got to roll over quite soon, Ewen? Do you think they've got to move off zero COVID soon to get private wealth managers out, to get institutional bankers back at the relationship table?
Look, I think it's up to the Hong Kong government to do what's in the best interest of their people. Clearly, I think in some of the elderly population of Hong Kong, the vaccination rates are very low. So I understand that they're concerned about that and trying to get that vaccination rate up before they get to a position of considering how to reopen the economy.
Let's just finish off with the bonus pool. It'll be a well-read story. So where we go with this, you're up by 31%. This is, a hot market. We've heard it from every CEO and CFO that I speak to. Of that 31%, is the majority of that going into the investment bank? Are there going to be bigger payouts to retain in IB relative to WM? Where is the flow of the 31%, so to speak?
Yeah, I mean, the 31%, I think, has to be seen in context of what we did the previous year. Unlike many of our peers, we actually took the bonus pool down around 20% last year. So I think overall, if you compare it to 2019, it's up just under 5%. And think of in terms of, where we are seeing higher pressure in the business, it's areas like the investment bank, technology, wealth. But we are seeing consistent wage pressure, I think, across the organisation. And we have done a really, really good job in managing that cost pressure within an overall flat cost for last year. But we want to remain competitive with the market, and hence why we had to take the pool up a bit more than what we would have thought a few months ago.